Welcome to another episode of Rad Accounting Tutorials. So, today we're going to discuss the principles of double entry bookkeeping. Today we are going to discuss the double entry bookkeeping. So, before you continue, please subscribe to my channel, Rad Accounting Tutorial, so you have an update on all my videos that I'll be uploaded. Okay, fast forward, let's continue. So today, the chapter of this principles of bookkeeping entry. So the chapter you are going to explain the double entry principle, explain the term debit entry and credit entry in accounting. We're going to discuss the record transactions, talk about transactions involving assets, liabilities, capital, revenue, and expenses using the double entry principle. We are going to talk about the books, the principal books of accounts, which is also known as the ledger. And we're going to talk about the division of the ledger. And lastly, we talk about the types of accounts in a ledger. So the double entry. The double entry is a system which involves recording transaction twice. That is the double entry. It involves recording transaction twice. That is, anytime a transaction occurs, the double entry principle is saying it should be recorded twice. That is, two parties are involved. Two parties are involved. Just like an agreement, just like two parties in an agreement. For example, for every sale transaction, there must be a seller and a buyer. You get it? And also, if you are borrowing money or borrowing something, there must be a borrower and what? A lender. So for every agreement, there are two parties involved. This is what the double entry is saying. For every transaction, there are two parties involved. So it must be recorded twice. That is what the double entry principle is saying. So the double entry principle states that every transaction affects two books or accounts. That is, one is the receiving book, and the other book is what? Is the giving book or account. The rule is we should debit the receiving book or account and credit the book that is given out. That is the whole concept of double entry principle. Should debit the book receiving and credit the book giving. And also in the book or in the account, the left hand side is always the debit side. The left hand side is always the debit side. And the right hand side of the book is the credit side. So with a double entry system, entries are made such that every debit entry has a credit entry, and every credit entry has a corresponding entry. That is, anytime there is a debit entry, the next entry should be a credit entry. Anytime there is a credit entry, the corresponding entry should be a debit entry. That is the whole concept of the double entry principle. Okay, so let's continue. We have here we are going to talk about the recording of transactions involving assets, liabilities, capital, revenue, and expenses using the double entry principle. That is, when there is a transaction involving assets, liabilities, how do we record them using a double entry principle? So the double entry principle is saying that we should debit to increase an asset and we should credit to decrease an asset. That is, if a transaction occurs and the transaction is increasing, we should debit the book involved in this transaction. We should debit the book involved in this transaction. So let's say we bought motor vehicle by cash. Bought motor vehicle by cash. Here, motor vehicle is an asset and cash is also an asset. So here we are going to take money from the business to purchase a motor vehicle. Here it means our cash of the business is going to decrease since we are going to take money from the business outside to purchase the motor vehicle. So here cash is an asset which is going to decrease. So the double entry is saying that if the asset is decreasing, we should credit it. So here it means we are going to credit our cash book. Hope it's clear. And here the motor vehicle is coming into the business, it's coming back to the company. So here it means our motor vehicle is going to increase. So if the company already have two motor vehicles, we are purchasing a new motor vehicle to make our motor vehicle three, which means our asset is going to what? Increase. So here, if our asset is going to increase, we are going to what? We are going to debit our motor vehicle account. So here, the two accounts or the two books involved here is a motor vehicle and the cash account. The cash account, the cash is decreasing. The double entry principle is saying that if the asset is decreasing, we should credit it. So here, we're going to credit our cash. The motor vehicle is what? It's an asset which is also increasing. So double entry is saying that if it is increasing, we should debit it. So we are going to debit motor vehicle in the name of cash. That is what the first rule is saying. We should debit to increase assets and credit to decrease assets. Two, debit to decrease liabilities and capital and credit to increase liabilities. Here it is saying that anytime a transaction occurs and the transaction involves liabilities and capital, if after the transaction occurred, it is decreasing liability, we should debit it. And if the transaction is decreasing our capital, we should debit it. And if the transaction is increasing our liabilities, we should what? Credit it. So for example, if the owner withdraws cash for personal use, here drawings, it is capital. That's the owner is withdrawing money from the business for personal use. So it means the capital of the owner is going towards decrease. So here we have to what? Debit. So since it is, they are saying that if it is decreasing capital, we should what? Debit it. So we are going to open a drawings account and debit the drawings account. Liabilities. An example of a liability is creditor. If we pay our creditor, if we pay our creditor, the amount that we are owing to our creditor is going to what? Decrease. So they are saying that if the transaction is going to decrease the, the ability, we should what? Debit. So if we make payment to our creditor, then it means we are going to debit. So if we make payment to our creditor, it's going to decrease the amount that we owe to our creditor. Therefore, we are going to what? Debit our creditor's account. That is what it is also saying. Three is saying that three, we should debit to increase expenses and decrease revenue. We should debit to increase expenses and decrease expenses. So that is what this is saying. If there is increase in expenses, we should debit it. And if there is decrease in revenue, we should debit. That is what this is also saying. So in a case of the expenses, if cash purchases is made, if cash purchases is made, that is, we purchase goods in cash. We made purchases with cash. Here, the cash account will be credited because our asset is what? Decreasing. So our cash account will be credited. And our purchases account will be what? Be debited. And this shows that there is increase in expenses. That is what the debit to increase in expenses also say, that if there is increase in expenses, we should debit it. So something like cash purchases. Cash purchases. So if there is cash purchases, we are going to credit our cash. That means there is decrease in assets. And we are going to debit our purchases account. So debiting our purchase accounts indicates that there is increase in what? Expenses. Decrease in revenue. If there is decrease in revenue, let's say, for example, we've sold goods to a customer, and here our customer has returned the goods because of faulty goods. So if our customer returns these goods, we are going to we are going to open a return inwards account because of goods return. So if we open a return inwards account, we are going to debit our return inwards account. You get it? So let's say, let me not use, for example, let me use the sales account. So if we make sales to a customer, we are going to credit our sales account for the sales that we made. Do you get it? So if the goods, that sales goods are returned, what we have to do is we have to debit our sales accounts to show a decrease in revenue. So when we were selling, we credit our sales account. And now the goods are being returned. So it means revenue is going to decrease because the goods are being returned. So if the goods are being returned, then since we are receiving, we are going to what? We are going to debit our sales account, showing a decrease in revenue. But then we use the return inwards to record goods that are being returned. That is it. Then that is for the three. So the four is credit to increase revenue and decrease expenses. Credit to increase revenue and decrease expenses. So credit to increase revenue. If we make sales, if we make sales, our revenue is what? Increasing. So that's why we open a sales account and we credit it. So anytime there is sales, we credit our sales account to show an increase in what? Revenue. To show an increase in revenue. To show an increase in revenue. So anytime there is sales, we open the sales account to to credit it, and this indicates that there is increase in. That is it. So let's take these examples. We said one is bought furniture for 400 cash. Here, the accounts involved here is furniture and what? Cash. Both are assets. One is an current asset, one is an asset. Here, we are buying the furniture. Cash, which means our cash will be leaving the business, which means our cash will be decreasing. So here, what we have to do is we have to credit our cash with 400 Ghana cedis in the name of what? Furniture. The furniture is coming to the business. It means our assets is going to what? Our asset is going to increase. If our asset is going to increase, then we have to what? Debit the furniture account in the name of cash. Two, bought goods on credit for 500 cedis. So we bought goods on credit, which means we purchased goods which are inventory. So here, the two accounts involved is the purchases account and the creditors account, not inventory account. We use the purchases account to record goods or inventory. So anytime you see goods, it is the purchases account that you open. So we use the purchases account to record goods or inventory. So here we bought the goods on credit, which means we did not make payment. If we did not make payment, then it means our liability is going to what? Increase. We did not make payment, so it means our liability is what's going to what? Increase. And the principle, the double entry principle is saying that if your liability is going to increase, then do what? Credit it. So we are going to open our creditors account and what? Credit the amount there in the name of purchases count. Then for our inventory, which is the goods, will be coming into the business. Although we've not made payment, it is still coming to the business, which is going to increase our assets. So if it is going to increase our assets, then we should do what? Debit it. That is all about the double entry principle. Then three, he said pay the expenses by 200 cedis by cash. So paying expenses, that means we are going to pay cash. So it means we are taking 200 cedis from the business to pay these expenses. That means the cash of the business is going to what? Decrease, which cash is an expense. Sorry, cash is an asset. They are saying that if the asset is decreasing, then we should do what? We should credit it. So we are going to credit our cash account. And now we paid for this expense, and this expense has increased. So paying for the expense increasing. So here our expense is going to what? Increase. So the rule is saying that if the expense is increasing, then we should what? Debit it. That is the principles of the double entry. Very simple. Also, if you want to look at it in this way, the giving and the receiver. With the first example, what furniture for cash? There are two accounts involved here, which is the furniture account and the cash account. So here for cash, so when we are going to make the purchase, we are going to take the money from cash. So we see cash as a person and see furniture as a person. So these two people in this transaction. Now we are going to make a purchase from we're going to buy a furniture. So here we are going to take the money from our cash and give it to furniture. These are the two parties involved in this transaction. So here, cash is going to give money to who? Furniture. So here, the cash is giving and furniture is what receiving. And the double entry principle is saying that we should what? We should credit the giver and debit what? The receiver. So we are going to credit the cash account and debit what? The furniture account. That is it. The second one is a bought goods on credit for 500 cedis. There are two parties involved here. That is the purchase account. Since it is goods, we don't say goods account. We use the purchase account to record goods or inventory. So when it is goods, it is purchase account that is involved. So we have the purchase account, and since it was bought on credit, and then what creditors account. So see them as two parties. We have the purchases and what the creditor. Here, who is giving? We ask ourselves who is giving and who is receiving. It is the creditor that is giving us the goods. It is the creditor that is giving us the goods. So we went to buy the goods for the creditor without making payment. So here, the only person that is giving here is the creditor who gave us the goods, and we also want to receive the goods. So here, there's the purchasing account that is receiving, which is used to record the inventory, that's the goods, and the creditor is giving. So we are going to credit the creditor's account and what debit the purchases account. That is the double entry principle. We made the debit entry and the credit entry. And the last one is pay the expenses 200 cities by cash. Pay the expenses. So here the account involved here is the expenses account and the cash account. So the expenses account and the cash account. You ask yourself who is giving and who is receiving. If they are going to pay expenses, we are going to take money from cash and give it to expenses. Here, I want to say that cash is what's giving, the expenses is what receiving. So we are going to credit the cash accounts with 200 CDs in the name of expense. Yes, cash give expenses 200 CDs. And expenses is also going to debit saying that I received 200 CDs from cash. That is the whole concept of the double entry principle. Okay, let's continue. Believe you are following and you will get it. So let's move to the principal books of accounts. That is known as, also referred to as the ledger. The ledger. So when we talk about the ledger, there's the major books which are kept by business organization in recording transactions on daily basis. So the ledger is the resting place or final place for all transactions. So after it has been recorded in the journal, it's now transferred to the ledger books. That is what we call the ledger. That is what we call the ledger. That is what we call the ledger. So the ledger summarizes transactions relating to assets, liability, capital, income, and expenses. It serves as a final and permanent record of business transaction. That is the ledger. This is also known as the principal books of accounts. So the ledger contain accounts. It is in the ledger that we find the account. So there are divisions of the ledger, and that is the sales ledger, the purchases ledger, the cash book, and the general ledger. So the cash book, so you have to note this. It is the cash book which is referred to as a journal and is at the same time referred to as what? A ledger. Journal and ledger, because a cash book, when there is a transaction involved, this First, it is a book of original entry. That's when the transaction occurs. That is where it is first recorded. And when it comes to the ledger, it is the cash book also has a debit side and a credit side. That's why you see it is a journal and at the same time it is a ledger. So let's talk about the sales ledger. Let's talk about the sales ledger. When we talk about the sales ledger contains all the personal account of credit customers. That is the sales ledger. It contains all the personal account of credit customers. That is the trade receivables of a that is the debtors of a business. That is what we call the sales ledger. And please let's note this. The sales ledger does not contain the sales account. The sales ledger does not contain the sales account. The sales ledger contains credit customers, transactions of credit customers. That is what we call the sales ledger. That is what we call the sales ledger. Let's be very mindful of. Then let's move to the purchases ledger. So the purchase ledger, it reports all transactions affecting creditors or if there is credit purchases. That is what we call the purchases ledger. That is what we call the purchases ledger. So the purchase ledger contains personal accounts of the trade payables of a business. And also let's note this. The purchases account does not contain the purchases ledger does not contain the purchases account. The purchases account because the purchase account is records cash purchases. So when we buy cash, that is where it goes as the purchases account. But the purchases ledger, it contains credit purchases. That is we when we record in our purchases journal, then we transfer to our purchases ledger. We transfer it to our purchases ledger. That's why under the when you're preparing your purchases journal under the folio, you write PL. That is the purchases ledger, saying that it is transferred to the purchases ledger one or purchase ledger two. Purchase ledger records credit purchases. It contains all the personal accounts, that is personal accounts of credit purchases. So that is it. So then we move to the cash book. So the cash book contains the cash accounts and bank accounts. That is the cash book. So the cash book records or keeps all cash and bank transactions of the firm. It is a ledger that is the final resting place of the cash and bank transaction. That is the cash book. It contains both the cash and bank accounts, which records all cash and bank transactions. Also, we have the general ledger, which is also called the nominal ledger or impersonal ledger. So the general ledger, it contains all the accounts that do not appear in any of the other three ledgers. That is all all, all the accounts that do not appear in the sales ledger, purchases ledger, and cash book. All the accounts that do not appear or that cannot be recorded in these ledgers, we record it in the general ledger. That is it. That is what we call the general ledger. So now let's move to the types of accounts. So when you go to the ledger, we have that's where we have the account. So the account in the ledger can also be categorized into personal and impersonal account. So types of account, we have the personal account and impersonal account. So when we talk about the personal account, it consists of transactions with people and other organization. That is what we call the personal account. That is what we call the personal. So an example is the debtor. An example is a creditor. So that is the personal account. The personal account involves people. That is what we call the personal account. Then let's move to the impersonal account. When we talk about impersonal accounts, they are used to record transactions other than those relating to persons or organizations. So if there's a transaction and it does not involve people or organization, then the account that it is recorded in is what we call impersonal account. So under this impersonal account, we have the real account and the nominal account. So these two does not involve any person or organization. So under the impersonal account, so the real account and nominal account falls under the impersonal account. And the real account is used to record tangible items such as what motor vehicle, land and building, inventory, equipment, and all those tangible items that we have. It is the real that all those accounts are called real accounts. So motor vehicle account is a real account. Land and building account is a real account. Yeah. But are there any other tangible items that you know? Equipment account is real account. All account that is tangible. That means tangible means we can touch. We can see and touch. It is what we call the tangible. So equipment account, inventory account, all these accounts are real accounts. Then we move to the nominal account. The nominal account is used to record items which do not have physical existence. It does not have physical existence. That is what we call nominal account. So rent account, advertising account, electricity account, discount received account, rent and rate. So all these things we can't see them. We can't see rent. We can't see discount received. We can't see electricity expense and all those things. They don't have physical existence. So those accounts are what we call the nominal account. That is so. So we are going to end our section here. Thank you very much for watching my video. Please click on the subscription account to get an update on all videos that will be uploaded here. There will be more videos here for you. So click on the subscription account and let's make the account great or the channel great. See you in my next video. So I'll be bringing tutorial sets to solve with you on the double entry principle. I encourage you to click on the subscription account. When this video is uploaded, you'll have a notification. Bye bye. See you in my next video.